Hey, Thomas, very good to see you. I want to talk about the recent market sell-off and volatility. The S&P recently booked its seventh consecutive weekly decline, marking only the fourth time in history that has happened. And the Dow Jones was in the eighth consecutive down week. We haven't seen that since 1932, which was during the Great Depression, of course. And if that weren't enough, I want to show you this chart from FinViz, which shows us the S&P for the past month. We see a lot of red, a lot of green. When we see this kind of all over the map, what are we supposed to do?
Well, so yeah, I mean, so there's, the green is good, right? Red is bad, right?
Right.
I mean, a lot of people are probably looking at the portfolios and they're seeing that they're down in certain positions. I truly believe you have a couple different types of investors. You have those active investors who are actively trading, and then you have those who are passive investors who buy and hold. I'm one of the latter. I know that over time, by holding on to certain positions, you outperform. However, I do believe in not being married to a certain position. If it hasn't, it might have served you well in the past, and sometimes that ride is over in that particular stock may not be worth staying in. So depending on where you're at in life, if you're closing in on retirement, you may want to look at reallocation. If you're younger and you have a long time horizon, I'm an advocate of that buy and hold strategy and kind of riding out the storms. We know that things are cyclical.
Very important to follow that financial plan and not react emotionally. And I know you know this because you've studied 30 years of data with behavioral finance, that during market downturns, people tend to panic and sell precisely when they shouldn't, right? What are we looking at here?
Yeah, we're looking at a cyclical, an emotional cycle, if you will. As people buy in, that buy low, high, sell high strategy. Typically, we're going to ride that wave up. We're feeling good at the top once we got in at a low amount, and then when that stock starts to tumble, then we go through that panic. That panic emotion where we're looking at what do we do? Should we buy? I think it's always good to have that conversation with an advisor. Myself, I will be able to kind of help you navigate through that. Sometimes it's good to have somebody else managing that so you don't have to deal with the emotions of riding the stock waves.
Right, because we are humans. And also to kind of underscore that point, we got this chart from our Brookstone CIO, Mark Diorio, who takes a look here at a $10,000 investment over a 15-year period. And over 15 years, it would turn into $45,000. But if you miss just the 10 best days, Thomas, your profits are essentially halved. And those good days and bad days are often right up against each other.
You got it. Yeah, that's a pretty powerful slide. In fact, we talked about this before.
Right.
I mean, just missing 10 of the best days, you lose half of the potential performance of your overall portfolio. So that goes back to that, that passive strategy. Sometimes it's good to stay to hold on. I always advocate having a diversified strategy, a diversified portfolio, if you will, so that you won't feel the full blow of the market, if you will, if it's stocks or bonds or however we allocate you.
Meanwhile, there are some experts who are advising investors to be defensive. What does it mean to be defensive as an investor?
Yeah, so there's a couple of different ways. So if you want to be defensive from a stock position, you're looking at companies or things that you typically buy, whether the market is doing well or not. Right now, and you're still going to need toothpaste. You're still going to need to go out and buy toilet paper, believe it or not. And when people are having that toilet paper craze, people are still going to need that type of stuff. So if you're looking at companies that produce those types of things, utilities, for instance, power, energy, we're still going to need that regardless of how the market goes. So when somebody's being defensive, they're looking for positions that are going to stay constant, maybe even pay dividends throughout the market cycles.
All right. Well, it's good to know that there are options. It's also really helpful just to talk this through with you, talk me off the ledge. I've said it before. So Thomas, if somebody would like your help during these difficult moments with the market, what's the best way to reach you?
You got to obviously reach out to me on my website, Martin Heritage Group LLC.com. There's some links there that you can schedule some time. You can also email me at info@martinheritagegroup.llc.com. Give me a call, 651-503-6064. I'm on all the social media platforms at Martin Heritage Group LLC.
Very easy. All right, Thomas, thank you.
Thank you.